I want to talk about derivative products, and in particular, I want to talk about options. Within options, right now, I want to talk about put options. Essentially, all derivative products can be spoken about and explained from a speculative and from a trading perspective. I wouldn't want to do that because if we really want to know the essence of the product, it's important to know that why were they designed. And all derivative products were designed from a very clear objective of wanting to manage risk, right. So, from a risk management perspective, I want to talk about that why was a put option designed, what are the characteristics of a put option, and then once you've understood this, you can actually use it very confidently for trading, for speculation, for risk management, so on and so forth, right. So, here is the small story that I want to use to build up for the purpose of designing a put option. Let us assume that you are a crude oil extraction company. Let us say you are 10 years, 15 years ago, ONGC, it's a PSU, essentially public sector unit, Government of India enterprise. What it does is it drills for crude oil and it extracts crude oil and sells crude oil to refiners. So, crude oil happens to be a finished product, finished goods for ONGC as a company. You can think of any other listed, unlisted entity, a pure play extraction company, all right. Now, what is the risk that typically an oil extraction company faces? When you bid and when you buy huge pieces of land, you're not sure of how much oil will you be able to drill out of it, right. So, there is a probability attached to it, but you have to go and invest that money beforehand, right. Once you've invested that money, drilling is a very long drawn process, right. It will take for you a year or two to actually get a site where you have commercial grade crude oil that you are able to extract. And while you are doing all of this, crude oil prices tend to go up and down, right. So, there is very clear a possibility that by the time you have the product on hand to sell to a refiner, crude oil prices have gone down and the entire project looks unviable because essentially the prices of crude oil have crashed, right. So, let me write this down and give you a perspective that if you are an oil exploration company, right, let us say you are ONGC in an Indian context, then you have the risk that crude oil price could go down, right. We have got to be clear about this as a risk, that is oil prices going down, right. Let us say spot price is $60 a barrel, all right, and you expect that over the next quarter prices could come down to $45 a barrel, right. Why do you expect this? There could be a lot of geopolitical reasons because of which you are saying there is excess oversupply. For example, you could have US drilling more, you could have more oil discoveries in the Gulf, because of which there is very clearly oversupply and muted demand, right. Maybe the entire market is moving towards renewable energy and people are not looking at crude oil as an energy source, and hence there isn't sufficient demand, because of which prices are going to go down, right. So, several reasons. Now, if you are an oil exploration company, essentially you are not going to pull the plug, you will have to do business, you will go ahead and still acquire land, do offshore, onshore drilling, and you will at the end of it have XYZ million barrels of oil to sell. With this uncertainty that current prices are $60 a barrel, and drilling cost and packaging and all of this will keep on increasing over a period of time, and the market price is going down, and hence you are making losses, right. So, what do you want? You want something as a product to manage this risk, and what is this risk? The risk that crude oil prices could go down. So, typically an oil exploration company will get in touch with a refiner saying that you are my purchaser, I want to get into a forward contract with you. I want you to lock in crude oil prices for what I can sell in the next quarter. Why do I want to do that? Because that lock in gives me the comfort, all right, the comfort that I know that I can sell at a particular price, and that particular price is a floor price, right. So, let us say I get into a forward sale contract with a refiner at let us say $55 a barrel. So, I am anticipating that crude oil prices could go down from the spot, but here is a refiner who says that I am willing to buy at 55, right. At least I am secured now as an exploration company that whatever finished product that I have, which is crude oil, even if market prices go down to 45, I will still be able to sell to the refiner at what? 55. So, that does not give me a sleepless night, right. The risk that prices could go down is managed because I know I can sell at what? 55. I have a purchaser there who is committed to buy XYZ million barrels of oil over the next 1 month, over the next 2 months at $55 a barrel. So, that solves the problem of prices going down. However, the limitation of a forward contract is that it is binding on both the parties. So, I will have to sell and the refiner will have to purchase. None of us can back out. There are penalties associated with backing out. So, in trying to solve one problem, I have now gotten into another problem. I anticipate that crude oil prices could go down, but what if prices go up? What if in the next 1 month, because of geopolitical pressure, because of let us say supply chains getting choked up, various other reasons, crude oil prices start going up, and let us say prices are up to $80 a barrel, right. Can I go out and sell at 80, or will I be forced to sell at 55? I will have to execute the forward contract at 55. So, please understand, the problem with the forward contract is that I want to protect myself as far as the downside risk is concerned, but I also want to participate in the upside potential, which a forward contract does not allow me to do. So, let us assume here is an angel who walks in and says that I will solve this problem for you, right. Let us say there is somebody who writes the following on a piece of paper saying that I promise to buy crude oil from you at $55 a barrel over the next 3 months if you may want to sell, all right. Somebody signed this for you, right. Do you notice the word you may want to sell? This particular note, this particular contract is a win-win for me as an oil exploration company because it gives me the option to sell. It does not force me to sell, right. In a forward contract, I was committed to sell at 55. In this contract, I am not committed to sell, I have the option to sell at 55. Hence, if crude prices are at what were we anticipating? We were anticipating that prices could go down to 45. If after 3 months crude is trading at 45, I will definitely come to you and sell to you at 55 because that makes sense. However, in the unlikely scenario of crude prices going up to $80 a barrel, I will choose not to come to you and sell at 55, but I will go out in the open market and sell at 80. So, what you have done is you have made me really comfortable by giving me a product that manages my downside potential. If prices go down, I come and sell to you at 55. But if prices go up, because you have written you may, right, I will choose not to because I have an option to not to come to you and sell. And this is what I call as a put option. Why do I call it a put option? Because it gives me the right to put or the right to sell. I can put barrels in front of you and ask you to pick it up at 55. So, I have the right to sell crude oil to you at 55. The word right indicates that I will not be forced, all right. The word right indicates that I have an option to sell or not to sell, right. How does it play for you? Suppose you sign this contract, all right. What's the deal for you? The deal for you is lopsided. You don't have an option, you have an obligation, because if I exercise my right to sell, then you have an obligation to buy. Hence, if I come to you and sell crude oil at 55, you can't back out. You will have to buy it at $55 a barrel. Now think about it, when will I come and sell to you? When market prices are 45, right? So overall market price is 45, but you will be forced to buy from me at 55. So is that a loss for you? Yes, but that's the nature of the product. The product ain't made for you, the product is made for me, for my risk management. And what was the risk that I had? That prices could go down, right? Hence, if I were to define a put option, it's a product which gives somebody the right to sell. Who's that somebody? It's me, ONGC right now, the oil exploration company. So, the product is made for me, I have the right, you have the obligation. Obviously, you are the service provider, you are giving me this service and you are going to ask for some payment, right? You are not going to do this free. What you will say is that give me some money upfront. Why would you ask for this money upfront? Is because you are not sure whether I will come to you to sell crude oil at the end of 3 months, right? I may not, and hence you are saying give me the money upfront. Let us say you ask for $5 a barrel, all right. This could be $1 a barrel, it could be $2.5 a barrel. We will come to pricing later on, but technically this is known as the premium on the put option, all right. This premium I will have to pay to you, all right. So, premium is an income for whom? For the writer slash seller of the put option. So, the word writer is you wrote this option for me, you sold this piece of contract to me, I bought this. So, I am the buyer. Who am I? I am the buyer of the put, all right. This should not be confusing. A lot of people mess it up when it comes to understanding a put option, because there are two contradictory words. Who is ONGC? The buyer of the put option. And what does the buyer of the put option get? The right to sell. So, you have the word sell associated with the word buyer. So, that is what makes the product a bit confusing, but let us just break it up. You are the buyer of the option which gives you the right to sell the underlying asset. What is the underlying asset? In our case, the underlying asset is crude oil, right? So, by buying this option from, you know, the third party, the writer, what do you get? You get the right to sell the underlying asset. In this case, it's a commodity, it's oil, but the underlying asset could have been a currency, the underlying asset could have been a stock. So, the derivative product, why do you use the word derivative? Because this product derives its value from the underlying asset, which is crude oil. Had this product been, let us say, a currency derivative, then the underlying asset could have been a dollar or a Japanese yen or Swiss dollars, whatever, right. Essentially, the word derivative means a product which derives its value from an underlying asset. The underlying asset could be a commodity, could be a a currency, it could be a stock as well. So, this could be the right to sell a stock. So, right to sell an Nvidia, the right to sell in Infosys, so on and so forth, right. As against that, the other party, who is known as the writer of the option or the seller of the option, has an obligation to buy the underlying asset. Again, two contradictory words. Who are you? You are the writer or the seller of the option, but what do you get? You get the obligation to buy the asset. So, the word obligation to buy as against seller of the option, right, makes it confusing. But if you are going to speak this out loud and clear, that you are the writer or the seller of the option, you are the service provider, and hence you take the obligation to buy the underlying asset, then things are pretty much clear. One or two technical words to add. I have introduced the word premium. Premium is an income for the writer of the option, it is an expense for the buyer of the option. The word 50, I mean the price of $55 is known as the strike price, alright. The word strike price is $55. That is the price at which we struck the deal, right. So, the deal is that I would be happy to sell to you at 55 and you will be obliged to buy from me at 55. So, the technical word is strike price, premium, and there is a maturity. The maturity of the option is 3 months, right. So, I hope this clarifies the nature of the product and this answers the question, why was a put option designed? It was essentially designed for a risk management perspective. And what is the risk that we are trying to manage through this? The risk that the underlying asset prices could go down. You can manage that risk. Why? Because you are able to set a floor price. $55 is a floor price. You will never sell crude oil below 55, because if prices go down, you exercise your right to sell at 55, and if prices go up, because you have an option to sell, which is the right to sell, you will go outside and sell in the open market, right. So, this answers the why, that why was a put option designed. There are two parties to a put option, the buyer of the put option and the writer of the put option. The buyer of the put option has the right to sell, the writer of the put option has an obligation to buy. He or she gets a premium for that, because that is a service that you are providing, whereas the buyer can manage risk, the buyer of the put option can manage risk, and hence you will have to pay premium. I hope this helps in understanding the basic nature of the product, which we call as a put option. Thank you. So, now that we have gone through the basics of a put option from the viewpoint of risk management, we can now discuss that how can you use put option as a product from a speculation, from a trading perspective. I want to specifically talk about the position of the buyer of a put option. What are the cash flows, what are the payoffs associated with the buyer of the put option. So, let us talk about the underlying asset being a stock now and not crude oil. This will be more relatable in that sense. So, let us say we are talking about put option, the position is a long position. In other words, we are talking about the buyer of a put. A long put means somebody who has bought a put option. The word long is equal to buy, the word short is equal to sell. So, you are not talking about the seller of a put or a short position on put options, we are talking about the buyer of a put. And we just discussed that the buyer of the put option has the right to sell the underlying asset for an agreed strike price. So, let us say you have this put option which has a strike price of 500 rupees as I have noted over here. So, you have the right to sell the underlying asset at 500. The premium involved in this put option is 25 and the maturity of the put option is 1 month. So, when you buy this put option, you have the right to sell the underlying asset which is a stock at 500 rupees. The other person, that is the writer of the put, will be obliged to buy. So, if you exercise your right to sell, he or she will have to buy at a price of 500. Obviously, the other person has, the writer of the put has an obligation to buy, and hence he or she is giving you services for which you will have to pay the premium. So, premium is an expense. Now, what I am going to do is, I am going to give you a range of prices at the end of 1 month, because the stock price could go up or it could go down. How will the buyer of the put behave if the stock price is X or Y? So, I want you to go through the decision making assuming that you are the buyer of the put, alright. So, let me give you a few alternatives. The expected market price and maturity, I am saying ranges from 100 rupees to, let us say, 900 rupees on maturity. So, two extremes given. Suppose after 1 month the stock price goes down to 100 or it goes up to 900. How are you going to behave if you have the right to sell this stock at a price of 500, right? Will you exercise your right to buy, right to sell or not, right? Let me change this, right to sell at 500 is what you have, right? I am going to say definitely yes, because I have a stock which I can go out and sell at 100, or I could sell to the writer of the put option at a strike price of 500. Obviously, I will choose to exercise my right to sell to the writer at a strike price of 500, and I will not choose to sell in the open market at 100. So, the decision is very clear. I am going to exercise my put option. Similarly, if the market price at the end of 1 month is 200, I will again exercise my right to sell at 500 because I want to earn more, right. If the market price at the end of 1 month of this underlying asset is 900 rupees, the decision is clear. I will not exercise my right to sell, because as the buyer of the put option, I see more money in selling my underlying asset, the stock, in the open market outside at 900 rather than selling it to the writer of the put option at a strike price of 500. So, I will let my option lapse. I will not exercise my right to sell at 500. Same is the case at 800 or 700 or 600, right. At 500 rupees, I am essentially indifferent. I can also say I will not exercise. Anything below 500, I hope you get it, I exercise my right to sell, right. So, now that the decision making is clear, let us talk about the payoff and the money that you will make out of this, or the money that you will lose out of this deal. I hope we are clear that we are going to be paying the premium. Why? Because we are the buyer of the put option, and the buyer of the put gets the right to sell. Somebody else on the other hand is taking the obligation for which he or she will earn money, and hence premium is an expense. The buyers of the option always end up paying the premium. It is a cash outflow. I have written minus 25 irrespective of whether this put option is exercised or not. 25 is something that we end up paying, right. Then let us look at our gross payoff, right. If the market price is 100 rupees outside and I have the right to sell at 500, would I not go out and buy this stock at 100 and then exercise my right to sell it to the writer of the put option at 500? So, am I not in the money by 400 rupees? I will again repeat this. At the end of 1 month, this stock is trading at 100. I am assuming that I will buy it in the open market at 100 and then I will exercise my right to sell at a strike price of 500. Hence, I make a gross profit of 400, right, and a net profit or a net payoff of 375. So, I am netting off the premium that I paid 25 against 400 to earn what? 375, alright. Let us do it one more time, right. Premium paid was 25 when the market price on maturity was 200, right. I have the right to sell the stock at 500 and hence I am assuming that I will go out in the market, it only makes sense to do that. I will go out and buy the stock at 200, exercise my right to sell at 500 and I will make a gross profit of 300, right, and a net profit of 275 after offsetting the premium that I paid. So, this put option earns 275 for me, right. If I just zip through and come to 900, does it make sense that I buy this stock at 900 in the open market and then exercise my right to sell at 500? It does not make sense doing that. Who is going to do that? And hence, I had written not exercise. I do not want to exercise my right to sell at 500. It does not make sense going out and buying this at 900 and hence my gross profit or loss is going to be 0. Nobody is going to be able to force me to do this thing, which is very foolish. The max that I end up losing is 25 rupees, the premium that I paid on the put option. So, think about it. I had the right to sell at 500 and the damn underlying asset was trading at 900. My right to sell at 500 was useless. I can tear this put option and bin it, saying that it was not useful to me. However, it did not result into a huge loss. It resulted into only a loss, which is a known loss of how much? The premium that I paid. In all these cases, when I do not exercise my put option, the max that I end up losing is 25, which is equal to the premium paid. In all these cases, when I exercised my put option, and I would encourage you to do the math now, right, what I ended up earning was 375 or 275 or 175, so on and so forth, right. Do you realize that unlike a call option, a put option gives me profits when market prices go down? It is a bearish product. When the market prices go up, I do not make money, I lose money in a put option. Exactly the opposite of a call. A call option was a bullish product, a put option happens to be a bearish product. It is in the money, it gives you money when the market prices tend to go down. So, if I were to look at the buyer of the put options position from the viewpoint of the payoff, it is a very clear position which says that there is a limited loss, alright. I cannot lose more than 25. So, let me zoom in over here and show you this. The maximum that I am losing is 25, which is when the market prices go up, because when the market prices go up, I do not exercise my put option. As market prices start going down, alright, what do? I start exercising the put option and I start recovering the premium paid. I make a profit of 75, I make a profit of 175, 275 and 375. When do I make 375? When the market prices on maturity are 100, right. So, from from the viewpoint of the buyer of the put, when should you buy a put option? You should buy a put option when you expect the market to be bearish, when you expect the market to break down. That's when your put options will get exercised, and that's when your put options will start paying off, right? Exactly the opposite. When should you buy a call option? When you expect that market prices will go up, when the market is going to move up, that's when the calls get exercised, right? So, one way of looking at the sentiment in the market is how many calls are getting exercised vis-a-vis how many puts are getting exercised, or how many call buyers exist in the market vis-a-vis put buyers. If there are a lot of people buying call options, then you can gauge the sentiment as a bullish sentiment. That why are so many buyers of call getting lined up? Because people are expecting to exercise their calls when the market goes up. So, the current built up in the position of call versus put can give you an insight into the future expectation of the market. Having said that, I hope the payoffs for the buyer of the put option are clear, and the fact. So, the key takeaways are that the put option is a bearish product. The maximum that you can lose is equal to the premium paid. The maximum that you can earn is the difference between the strike price and the premium paid. You can't make unlimited profit over here. 500 minus 25, the max that you can earn is 475 out of this, and it is a limited profit potential, but nonetheless it has a good profit potential, because the spread, the difference between 525, 475, it is a lot of money on an investment of 25. Hope that helps. Thank you.